What happens when the world's most powerful central bank gets pushed into a corner? What if the Federal Reserve, the gatekeeper of the global economy, is forced to cut rates? Not on its timeline, but on Trump's. Because that's exactly what's happening. According to JPMorgan's chief investment officer, the Fed may slash interest rates before its next scheduled meeting in May. And the reason? Trump's tariffs are shaking the foundation of an already fragile economy. Let's break it down.
Chapter 1. The Signal from Wall Street.
JPMorgan doesn't just speculate. When their CIO speaks, markets listen. This week, he issued a major warning. We believe the Federal Reserve may be forced to cut rates before the next FOMC meeting if current conditions persist. That's not just a policy prediction. That's a panic signal. Why? Because the three pillars of economic stability are all wobbling at the same time. Inflation remains stubbornly high. Job growth is slowing. And the stock market is taking hit after hit. Chapter 2. Trump's Tariff Torpedo. The immediate trigger? Trump's new round of tariffs.
Just last week, Trump imposed massive new import duties on cars from Japan and Germany,
Steel and aluminum from Brazil and South Korea, consumer electronics from Southeast Asia. Tariffs now affect over $1.3 trillion worth of imports. The effect? Rising costs for businesses, higher prices for consumers, and growing pressure on supply chains already under strain.
Markets reacted fast. Dow fell 800 points in 2 days.
S&P 500 off, nearly 4%. Bond yields plummeted as investors fled to safety. And the Fed is watching closely. Chapter 3. The Fed's Dilemma. Jerome Powell, chair of the Federal Reserve, is trying to keep calm. His latest statement: "We are closely monitoring economic data and will act as appropriate." Translation? We don't want to move yet, but we might have to. The challenge is this. Cut rates too early, you risk inflaming inflation. Wait too long,
you risk a market meltdown and a recession spiral.
Right now, Powell is trying to do the impossible: tame inflation, calm markets, and stay politically neutral, all at once. But with Trump turning up the heat, neutrality may not be an option for much longer. Chapter 4. Political pressure builds. Trump is not being subtle. He's publicly calling on the Fed to cut rates immediately, blaming Powell for being asleep at the wheel, while the U.S. economy faces external shocks. On Truth Social, Trump posted, "With these global tariffs, the Fed must act. Cut rates now or watch this economy freeze." This is more than a suggestion.
It's a direct command.
And even though the Fed is supposed to be independent, markets know better. Political pressure, especially from a president like Trump, moves markets. Chapter 5. Inflation, the elephant in the room. Here's the catch.
Inflation is still high. Despite steady rates, the CPI remains over 4%, well above the Fed's 2% target. Normally, the Fed wouldn't even think about cutting until inflation drops closer to target.
But the fear now is that sticking to that logic could tank the market. And worse, destroy fragile consumer confidence heading into Q3.
So the Fed faces a historic crossroads:
hold the line and risk a crash, or pivot early and risk reigniting inflation. Either way, someone loses. Chapter 6. Jobs data flashing red.
Just released. The latest jobs report missed expectations.
Only 98,000 new jobs were added versus 160,000 expected.
Unemployment ticked up to 4.2%.
Wage growth slowed to its lowest rate since 2021. This isn't recession territory yet, but it's heading in that direction.
And markets are pricing in pain.
If the labor market cracks, the Fed will be forced to act fast, even if inflation is still elevated. Because in the Fed's dual mandate, jobs and price stability, jobs come first in an election year. Chapter 7. Futures market is already moving. The bond market isn't waiting for the Fed.
The 10-year Treasury yield fell to 3.6%, its lowest in 6 months.
Fed funds futures now price in a 60% chance of a rate cut before the May meeting.
Gold is surging, up 5% on the week.
Bitcoin, up 12% as traders flee fiat volatility. Wall Street is already preparing for a cut. And if the Fed doesn't act soon, they might have to clean up a much bigger mess. Chapter 8. The Shadow of 2008. Veteran investors are seeing echoes of the past. In 2007, the Fed was slow to react to credit stress. By the time the cuts came, it was too late. Now, they're seeing warning signs again.
Yield curve still inverted.
Credit spreads widening. Liquidity drying up in small cap and real estate markets. The Fed doesn't want to repeat history, but history might already be repeating itself. Chapter 9. Global markets on edge. This isn't just a U.S. issue.
Global markets are reacting to the Fed's dilemma. Asian stocks fell 4% on fears of U.S. slowdown.
European banks are bracing for contagion. Oil prices dropped 6% as demand forecasts fall. In a globalized economy, one misstep from the Fed could ignite a chain reaction of economic downgrades worldwide.
So the world is watching and waiting.
Chapter 10. What happens next? Here are the 3 possible paths. Fed holds the line. No cut until May or later.
Market pain increases.
Recession risk spikes. Fed cuts in April before the meeting to calm markets. Inflation risk rises. Fed signals a May cut, but does nothing now. The middle path. May cause more volatility.
No outcome is perfect.
But in this environment, delay may be more dangerous than action. Because once the dam breaks, rate cuts won't be enough to fix what's flooding. Final thought. The Fed may act early.
Not because it wants to,
but because Trump's tariffs just lit a fuse under the economy. Whether it's politics, policy, or panic, the Fed is now on the clock. And the global economy.
It's holding its breath,